Every nation on Earth is in debt. The United States now owes over $38 trillion, the highest figure in its history. The European Union carries around $14 trillion. Japan, nearly $9 trillion. Even oil-rich nations like Saudi Arabia and export giants like Germany and China owe staggering amounts. But here's the paradox. If everyone owes money, who's actually owed? This is the Wealixon, where money, power, and history collide, and nothing is ever as simple as it seems. Debt isn't just a burden. It's the architecture of the modern world. Every war, every crisis, every boom and bust sits on an invisible scaffolding of IOUs. Follow that chain of creditors long enough, and you'll discover something unsettling. The world doesn't owe money to anyone in particular. It owes it to itself. But not everyone benefits equally. To understand how we got here, a planet drowning in $315 trillion of total debt, nearly 3 times the size of the global economy, we need to go back to the beginning. Centuries before the first credit card swipe, the idea of national debt was born not on Wall Street, but on the battlefield. 1694, England versus France. England was running out of gold. The king turned to merchants for help. In exchange for a permanent stream of interest payments backed by future taxes, they financed the crown. To manage this new system, the Bank of England was created. It changed everything. The state could now spend money it didn't yet have, and lenders received something priceless, a promise from the government that could be traded, bought, or sold. That promise became the government bond, the seed of modern finance. France copied it, the Netherlands refined it, and the newly independent United States used it to fund its revolution, and later its expansion westward. Debt became not a mark of weakness, but a symbol of credibility. The ability to borrow was the ability to rule. Empires once conquered land for gold. Now they issued bonds for interest. The battlefield became the balance sheet. Fast forward 3 centuries, and debt has become the world's most powerful export. Every country owes. Every bank lends. Every citizen, through taxes, savings, and pensions, is both a debtor and a creditor. So who holds the other end of the rope? Let's start with the United States, because its debt isn't just national, it's global. Out of $38 trillion, about half is publicly held, owed to investors, not government entities. Roughly 2/3 of those investors are American. Banks, pension funds, insurance companies, mutual funds, and the Federal Reserve itself. The rest, about $9 trillion, sits in foreign hands. Japan holds around $1 trillion, China about $800 billion, followed by the UK, Luxembourg, and Belgium. So when people say America owes China, it's true, but only for around 2% of the total. Most of the debt America owes is to America. Here's how the loop works. The Treasury issues bonds. Banks and funds buy them. The Federal Reserve often buys them back, creating new dollars in the process. Americans pay taxes that fund interest on those bonds, which flow right back into American retirement accounts. It's a circular mirror. The debt is real, but the creditor is mostly a reflection of the same system. And that circularity isn't just American, it's global. Japan lends to the US through treasuries. The US lends to Europe through the IMF. Europe lends to developing nations through the World Bank. And developing nations lend back to advanced economies by parking reserves in Western bonds. It's a planetary loop of IOUs, a game of hot potato where the potato is made of promises. Every country holds someone else's debt. Every promise is backed by another promise. It's like a poker table where every player has borrowed chips from the next, and the only rule is no one leaves the table. But there's one more layer, the most powerful of all, the markets themselves. Behind every government bond sits a web of hedge funds, pension funds, and central banks managing tens of trillions in assets. They are the true arbiters of credit. They decide which nations borrow cheaply and which must pay to survive. When they lose confidence, currencies collapse, governments fall, and economies reset overnight. Democracy decides who governs. Markets decide who survives. And the ultimate market maker, the modern high priest of this system, is the central bank. Central banks don't just manage debt, they manufacture it. Every time the Federal Reserve or European Central Bank buys bonds, it creates new money in exchange. The liability of one balance sheet becomes the asset of another. Every dollar in circulation represents a unit of debt somewhere else. There is no such thing as debt-free money. Every coin, bill, and digital dollar carries an invisible IOU. For decades, this loop has run on one thing: confidence. As long as investors believe governments will pay interest, even if never the principal, the machine keeps turning. But when confidence cracks, everything changes. In 2010, Greece's debt crisis spiraled. Bondholders panicked, yields spiked, and the EU stepped in. But their rescue demanded sacrifice: austerity, taxes, unemployment. An entire generation learned that bailout can mean burden. Argentina defaulted repeatedly. Sri Lanka's crisis brought fuel shortages and political collapse. When the system breaks, creditors suddenly appear. The IMF, rating agencies, anonymous bondholders holding entire nations by the throat. And yet, the same logic restarts. New loans replace old ones. Old debts are restructured. The machine resets. Because in the modern world, debt isn't meant to be repaid, it's meant to be refinanced. Governments treat it like a rolling subscription, issuing new bonds to pay off old ones. Interest becomes the real product, the rent charged for stability. The global economy now depends on that rent, like a shark that must keep swimming to breathe. The US will never pay off its $38 trillion debt. It will roll it forever. Japan has done the same for decades, now exceeding 250% of GDP, yet bond yields remain near zero. Why? Because investors don't want repayment. They want renewal. For them, government debt is the safest collateral on earth. A U.S. Treasury bond isn't a liability. It's an asset. Banks use it as security. Pension funds build portfolios around it. Central banks treat it as money itself. If governments ever paid off their debt completely, the world would lose its most trusted financial instrument. The dollar supply would shrink. Deflation would follow. Markets would collapse. So governments do the opposite. They issue more, not recklessly, but rhythmically. Debt becomes the heartbeat of capitalism, pulsing through every pension, mortgage, and market. When politicians talk about balancing the budget, they're selling an illusion. The goal isn't to eliminate debt, it's to keep it believable. Because once belief fades, numbers stop mattering. Confidence collapses, interest rates soar, and the economy built on rolling promises grinds to a halt. That's the real secret of sovereign debt. The plan was never to pay it back. The plan is to keep the world believing it will. As long as that belief holds, the numbers can stretch indefinitely. But trust isn't evenly shared. When we say we owe it to ourselves, that's only half true. Interest payments don't flow equally. They rise upward, from taxpayers and workers to the institutions and investors who hold the debt. Debt isn't just a transfer between countries. It's a transfer between classes. That's why global inequality and global indebtedness rise together. The system rewards those who own debt and punishes those who simply pay it. Debt once meant bondage. Today, it means balance. But if that balance ever tips, if confidence breaks, the illusion ends, and we'll remember what debt really is, a promise that can't be kept forever. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.